Yo, what's up, future millionaires? Fitzroy Butler here, and let's be real, starting to invest can feel like stepping into a casino in Vegas for the first time. Ever felt that rush of excitement to start growing your money, only to see your portfolio in the red, feel your stomach drop and think about cashing out? Trust me, you're not alone. Most new investors make the same mistakes, and those mistakes, they can cost you serious cash. We're talking thousands, even tens of thousands of dollars down the drain. But here's the good news. Today, we're diving deep into the 7 biggest investing mistakes beginners make, and more importantly, how you can dodge them like a pro. We'll break it down step by step so you can start investing with confidence and actually see those gains. Stick around because this is the information your financial advisor doesn't want you to know. This is invesYou, your wealth, your way. Alright, mistake number 1 that I see people making all the time is this. They jump into investing without a plan. It's like setting off on a cross-country road trip with no map, no destination in mind, and a half-empty tank of gas. You might end up somewhere, but it probably won't be where you wanted to go. Look, having a plan is crucial. It's the foundation for everything you do in investing. Without it, you're just gambling with your hard-earned cash. And trust me, the house always wins. So, what does a solid investing plan look like? First off, you need to define your financial goals. What are you trying to achieve with your investments? Are you saving for a down payment on a house, early retirement, building a college fund for your kids? Be specific, write those goals down, and put a timeline on them. Next up, you need to figure out your risk tolerance. How much of your money are you comfortable potentially losing in the short term to achieve those long-term goals? This is a big one. Are you someone who freaks out when your portfolio drops 5%? Or are you cool with riding out the ups and downs of the market? Your risk tolerance will determine what kind of investments you should be making. Remember, investing is a marathon, not a sprint. Don't compare your portfolio to others, don't chase the latest trends, and don't get discouraged by short-term fluctuations. Having a plan helps you stay focused on your goals, make rational decisions, and avoid those emotional knee-jerk reactions that can absolutely tank your returns. It's like having a financial roadmap, guiding you towards financial freedom, one smart investment at a time. So, before you even think about buying your first stock, ETF, or bond, sit down and create that plan. Trust me, your future self will thank you for it. Alright, let's talk about mistake number 2, and it's a big one, chasing the hottest stock. You know what I'm talking about? That feeling of FOMO, the fear of missing out, when you see everyone on social media bragging about their crazy gains on some meme stock or the latest crypto craze. Suddenly everyone's an expert, right? They're throwing around terms like diamond hands and to the moon, and you start feeling like you're the only one who isn't getting rich quick. But here's the truth. Chasing hot stocks is like trying to time the market. It's incredibly risky, and more often than not, it'll leave you burned. Think about it. By the time you hear about a stock on social media, chances are it's already gone up significantly. You're buying high, hoping to sell even higher, but what happens when the hype dies down? What happens when everyone else starts selling? That's right, the price crashes, and you're left holding the bag, wondering what hit you. Remember, investing is about making smart, calculated decisions based on solid research and a long-term strategy, not on hype, speculation, or what your favorite influencer is telling you to do. Instead of chasing the next big thing, focus on building a diversified portfolio of companies with solid fundamentals, companies that you understand, that have a track record of profitability, and that you believe in for the long haul. Don't get me wrong, there's nothing wrong with investing in individual stocks, but do your research, understand the risks, and don't put all your eggs in one basket, especially not a basket woven by hype and speculation. Remember, slow and steady wins the race. Focus on building a solid foundation for your financial future, and don't get distracted by the shiny objects. Okay, mistake number 3 is a big one, and it ties in closely with what we just talked about, not knowing what you're buying. Look, I get it, the stock market can feel like a giant, confusing casino, especially when you're first starting out. But here's the thing, you wouldn't walk into a car dealership and buy the first car you see without even looking under the hood, right? You'd do your research, compare different models, and figure out which car best suits your needs and your budget. The same goes for investing. Buying stocks or ETFs without understanding the underlying businesses, their financials, or their competitive landscape is like driving with your eyes closed. You might get lucky for a while, but eventually, you're going to crash and burn. So, what does it mean to know what you're buying? Well, it starts with understanding the basics of financial statements. Learn how to read a company's balance sheet, income statement, and cash flow statement. These documents give you a snapshot of a company's financial health, its profitability, and its debt levels. Next, research the company's industry, its competitors, and its management team. What are their competitive advantages? What are the risks they face? Are they innovating and adapting to changing market conditions? Remember, when you buy a stock, you're buying a piece of a business. So, treat it like you would any other investment. Do your due diligence, ask questions, and don't be afraid to walk away if something doesn't feel right. Alright, let's talk about mistake number 4, and it's one that even seasoned investors struggle with, trying to time the market. We've all been there, right? Seeing the market hit new highs and thinking, okay, it's gotta go down soon, right? Or watching it plummet and wondering if this is the bottom, if it's time to buy the dip. But here's the cold, hard truth. Timing the market consistently is virtually impossible, even for professional investors with years of experience and fancy algorithms. It's like trying to predict when lightning will strike. You might get lucky once or twice, but eventually you're going to get burned. Every time you sell, you're essentially making 2 bets. You're betting that the market will go down, and then you're betting that you'll be able to buy back in at a lower price. That's a lot of room for error, and even a small miscalculation can cost you big time. Instead of trying to time the market, focus on what you can control, time in the market. History has shown time and time again that over the long term, the stock market tends to go up. Sure, there will be dips and crashes along the way, but by staying invested and riding out those fluctuations, you give yourself the best chance of coming out ahead. Remember, investing is a marathon, not a sprint. Don't get caught up in the short-term noise. Focus on building a diversified portfolio, stick to your plan, and let time work its magic. Alright, let's talk about a mistake that might seem small but can absolutely kill your returns over time. Ignoring fees. You see those tiny percentages, those expense ratios on your mutual funds, those trading commissions, those advisory fees. They might not seem like much, but trust me, they add up. Think about it like this. Every dollar you pay in fees is a dollar that's not working for you, it's not growing, it's not compounding. It's like having a leak in your bucket. Even a small leak can drain your entire bucket over time. So, what can you do to minimize fees? First off, when it comes to mutual funds and ETFs, pay close attention to the expense ratio. This number represents the percentage of your assets that are taken out each year to cover the fund's operating costs. Now, a 1% expense ratio might not sound like a lot, but over 30 years, that 1% can eat up a significant chunk of your returns. Look for low-cost index funds and ETFs whenever possible. These funds passively track a specific market index like the S&P 500, and they typically have much lower expense ratios than actively managed funds. Next, be mindful of trading commissions. While many brokers now offer commission-free trading on stocks and ETFs, you'll still likely pay commissions for options trades or trades on other exchanges. Factor these costs into your investment decisions and make sure they align with your overall strategy. Finally, if you're working with a financial advisor, understand how they get paid and what fees they charge. Are they fee-based, charging a flat fee for their services? Or are they commission-based, earning a commission on the products they sell? Remember, knowledge is power. The more you understand about fees, the better equipped you'll be to minimize their impact on your returns. Let's talk about diversification, and no, I'm not talking about just having a few different stocks in your portfolio. I'm talking about true diversification, spreading your investments across different asset classes, sectors, industries, and even geographic regions. Remember the saying, don't put all your eggs in one basket? Well, in investing, that basket is your portfolio, and those eggs are your hard-earned money. If you put all your money into one stock, one sector, or even one asset class, you're essentially putting all your eggs in one basket, and if that basket drops, you're in trouble. Think of it like this. Let's say you invest all your money in a single tech company that's doing incredibly well, but then a new technology emerges disrupting the entire industry and that company's stock plummets. Suddenly, a significant chunk of your savings is gone. Diversification helps mitigate that risk by spreading your investments across different asset classes like stocks, bonds, real estate, and even alternative investments. You're creating a safety net for your portfolio. When one asset class is down, another might be up, balancing out your returns over time. Within each asset class, diversify further by investing in different sectors, industries, and company sizes. This ensures that your portfolio isn't overly reliant on the performance of a single sector or industry. Remember, diversification is your best defense against the unexpected. It's not about trying to pick winners and losers, it's about managing risk and protecting your hard-earned money. Alright, let's talk about the final and perhaps the most emotionally charged mistake beginners make selling during a dip. Picture this, you've been diligently investing, your portfolio is growing, and then BAM! The market takes a nosedive. Suddenly all those gains you've worked so hard for are gone, and you're staring at a sea of red. Your heart starts racing, your palms are sweaty, and you're tempted to hit that sell button before things get any worse. Trust me, I get it. Selling when the market is down is an instinctual reaction. It's human nature to want to avoid pain and protect what we've worked so hard for. But here's the thing. Selling during a dip often leads to the biggest regret in investing. Why? Because it locks in your losses and prevents you from participating in the eventual recovery. Remember, the stock market is cyclical. What goes down must come up. And by selling when the market is down, you're essentially selling low and missing out on the opportunity to buy low and sell high later on. Instead of panicking, take a deep breath and remember your long-term plan. Look beyond the short-term fluctuations and focus on the fundamentals of your investments. Are the companies you're invested in still fundamentally sound? Are their long-term prospects still intact? If the answer is yes, then staying the course might be the best approach. In fact, market downturns can present fantastic buying opportunities for long-term investors. When prices are lower, you have the chance to buy more shares of great companies at a discount, potentially accelerating your returns over time. Remember, investing is a marathon, not a sprint. Stay patient, stay disciplined, and don't let your emotions get the best of you. So there you have it, the 7 deadly sins of investing that can sabotage your financial future. Investing isn't about being perfect, it's about avoiding the big mistakes, sticking to a plan, and staying disciplined. Learn from these 7 beginner investing mistakes, and you'll be well on your way to building wealth. If this video helped you level up your investing game, hit that like button below, subscribe to invesYou for more financial wisdom bombs, and leave a comment telling me, I'm in it for the long term, if you're ready to invest smarter. Now go check out my video on how to start investing with just $100. It's the perfect next step on your journey to financial freedom. And don't forget to grab your free investing starter guide at invesYou.com. It's packed with even more tips and strategies to help you crush your financial goals. See you in the next video.